Chris, Morgan Stanley holding a banking conference in London next week. What sort of picture do you think we're going to see this year compared to this time last year?
Yeah, I think last year was all about survival, but as it turns out, actually the banks had a reasonable year. What we think will happen in 2010 is that actually the investment banks will struggle a little bit to grow their revenues and earnings this year. And that's predominantly a function of the factor that in a difficult year like last year, what generally happens is banks pull back from the markets. And in the fixed income trading business, which is still the biggest business at these Wall Street firms, the spreads tend to widen when you're trading fixed income products like commodities, credit, mortgage-backed securities. And so there was a significant spread widening in 2009, particularly in the first half. And the fixed income trading houses were able to take advantage of that. But as competition got back into the market and kind of banks got back on their feet, those spreads really came in. And so where we stand today in 2010 is that fixed income spreads on most products are down somewhere between 50 and 75% from where they were in 2009. So the ability to make money from wide spreads is much less prevalent in the fixed income business.
So when we go to this time next year, do you think profits are going to look significantly lower than we saw just a month or so ago?
Yeah, so we think globally, and it's quite tough to generalize about an industry that's so big and there are winners and losers within that, but we think generally investment banks will have revenues this year down anywhere between 15 and 20% relative to 2009. Driven, as I said, predominantly by the fixed income decline, which we think will be 20 to 25%, and then the equity trading business, which is the other big business for these banks, will be up single digits, predominantly because the rally in equity markets has already happened. So that's behind us in 2009. And what we're seeing so far this year is actually not great volume in the equity markets. It's kind of a little bit, it's a little bit illiquid, there's not much conviction, and we think that there's a decent chance that that may persist through the rest of the year.
How much do proposed regulatory changes muddy the waters for the outlook for the banking sector going forward from here?
Yeah, I must say I would hate to be running a bank at the moment. I mean, you've got so many things to have to think about, not least of which is the regulatory, potential regulatory impact. Look, if you're an investor and you're thinking about investing in banks, the way we look at it is we think returns on equity will decline by about 4% permanently, so for our foreseeable future, from regulatory change. So instead of being an industry that can generate, we're talking about international banks, somewhere between 18 and 20% returns on equity, we think that number is now going to be closer to sort of the 14, 15% range.
So they're really going into less lucrative deals. They give them those high margins going forward. We're going to have lower margin business, I should imagine.
Yeah, well, first of all, it's more capital. So I think the regulators got a fright that they had to be the lender of last resort. So they're saying to the banks, listen, you guys, you need to put more capital into your business because we're not going to support this industry from a systemic risk standpoint again. So we want higher equity in banks, so less leverage. That has an impact on your return on equity. And the second one is, yeah, so some of the more riskier business lines that the banks used to be participant in, like private equity, prop trading, these are typically higher ROE businesses. And those are the businesses that most of the investment banks now by their regulators are being encouraged to shrink.
Of course, we know banks like Goldman Sachs made a lot of money from proprietary trading. South African banks a lot less so. Would you group South African banks with this whole outlook we're looking at for global banks?
Yeah, I think it's different. I think on the regulatory front, clearly South Africa likes to also kind of see what's happening globally and adopt some of the best practice. I think hopefully the regulator here doesn't, if you like, overreact the way some of these developed markets might because we didn't have the kind of shock that they had. But I do think the same capital is going to go up. Banks are going to focus on capital light businesses. And so I think some of the impact will be here, but it won't be as dramatic as it is abroad. So maybe we shave off a couple of percent from the ROE instead of 4 or 5% like we think might happen internationally. And we actually like Standard Bank on that basis. So they have raised some capital. The sort of result of this regulatory changes is that we like banks that have strong flow businesses, trading flow businesses, as opposed to prop. We like emerging market exposure as opposed to developed market exposure. And we like transactional banking as opposed to sort of lending. And so you can tick pretty much all of those boxes with Standard Bank. And actually, when we look at banks globally now, Standard Bank stacks up very well as kind of not just an emerging market pick, but actually if you're running a global banks portfolio, it looks like a stock that you should own in that portfolio.
Of course, we had that stock trading yesterday to 118 Rand. That's an all-time high for Standard Bank. Though about 2 years ago, it was trading just below that level. So in 2 years, the share price hasn't moved very far. Of course, our banks are now looking at trying to mirror 2008's earnings. So it's not going to be a quick recovery, is it?
Yeah, and this is a challenge. I mean, I worry a little bit about the whole market at the moment. If you're thinking about just equity price levels, the retailers ran very hard in the last month or so, really because there were very few options out there for investors to invest in South Africa when China's tightening and you want to be a little bit careful about the commodity space. So where do you go? Well, you go into domestic names, and retailers were really the real beneficiaries because they just reported earnings, and the earnings were pretty good, and so they were quite cheap relative to Russian retailers, and so they had a bit of a rally, particularly driven by foreign investors. Now what seems to be happening is the banks are playing a little bit of catch up to that because they're sort of exposed to the same ultimate fundamentals, which is a recovery in the South African economy. Unfortunately, now we're in a situation where both banks and retailers are pretty expensive, even based on historical returns. So forgetting about the fact that future returns might be lower, driven by either a slow recovery or, in the bank's case, regulatory changes. So we're a little bit nervous about the market up here. We don't expect very big returns from the South African equity market this year.
Of course, we do know that the more defensive retailers have been running very hard. We've had a number of all-time highs in that sector as well. How about some of the less defensive, more cyclical retailers?
They've also had a pretty good time. I mean, if you think about Massmart, JD Group, Woolworths, a bit defensive, but it's also got some cyclicality in there. Truworths, these stocks are also hitting all-time highs. So, investors seem very prepared, at least for now, to be able to look through any kind of earnings cycle we see at the moment, and also increasingly backing quite a strong recovery in the domestic consumer. And we're not sure that we see that yet.
Well, another share that has been hitting all-time highs is Naspers, and of course its associate company Tencent just out with earnings, and that helping to boost Naspers' share price.
Yeah, it's funny. Actually, almost the contrary. I personally think there's some very interesting and potentially damaging regulatory changes in China that are starting to impact the internet media business there. You saw Google pulling out of China. They're concerned about some of the regulatory backlash and a Chinese regulator trying to control what they can and can't put on their website. And then there's, recently with Tencent, there's a bit of talk about how they're allowed to get paid by the telco providers for providing this internet gaming stuff on mobile phones. And so I worry a little bit that for a stock like Tencent that trades in the mid-30s PE multiple, any regulatory concern is potentially damaging to the rating of that stock. So what's been quite interesting is that Naspers is actually up, but Tencent's down. So Naspers is up 5 or 6% in the last couple of days. Tencent's down 8%. So what you're finding is that the rump, so the sort of pay TV business within inside Naspers, has had a massive re-rating. And so we think that that's probably gone a little bit too far in the short term. We still like Naspers because we sort of believers in internet media and the pay TV business here as being good businesses. But I would caution investors right now that there might be a bit of a pullback in that stock given what I said about Tencent.